We have with us today Ms. Ashima Goyal, a member of the RBI's Monetary Policy Committee. She is with us after the release of the minutes of the MPC's latest policy meeting. Thank you for your time, ma'am.
You're welcome. Nice to talk to you again.
You were the sole voice of dissent when it came to the rate hike. You had voted for 35 basis points while the rest were for 50. And you mentioned in the minutes that a real rate of more than 1% if inflation were to fall more than expected could be dangerous for growth. So, what would be your preferred real rate?
I think that real rate should not be more than 1% in today's circumstances. When we are just coming out of the pandemic shocks, growth is just recovering. But we don't want overheating. So a positive real rate is required, but it should not rise above 1%.
You have mentioned a fear-driven overreaction when it comes to maintaining the rate differentials with the US. Do you feel that there is a pressure on the MPC to respond to the Fed's action?
The MPC's mandate is domestic inflation and growth. Yeah, not the external sector, not the exchange rate, which is market determined. But I have, in my view, the interest differential does not matter so much for Indian exchange rate because we have caps on interest sensitive inflows and they are a very low share of our markets. So I really of our debt market, yeah, domestic. So therefore we need not worry so much about the US keeping up with the Fed rates. The US needs to raise rates because their inflation is high and sticky, much higher than their target band, much higher than our inflation. So we have to calibrate our rates and our real rates to our inflation.
So you mentioned in the minutes that India retains the policy space for smoothing global shocks. Does this imply space for rate cuts if there were to be another adverse global development?
By smoothing, I mean that our rates should be counter-cyclical to our domestic cycle, right? So, and it includes not just monetary policy, but fiscal and external, the reserve management, capital flow management. So there are a number of tools. And since we built up these large reserves and regulatory macroprudential tools, that can also be counter-cyclical. And we have used that very effectively. For example, a lot of the regulatory relaxation given just after the pandemic was time-bound, and that has been reversed with our financial sector remaining very strong. Our banks' balance sheets are in much better shape today than they were in the last decade. So that also, the financial sector strength and resilience also gives us policy space. It's not just about, cutting rates or raising them.
So turning to liquidity, you mentioned the need to counter the global QT and possible outflow. We've seen that money market rates have moved higher, and with regular instances of banks now tapping the MSF window. So in your view, should the central bank provide liquidity when the current surplus drains out durably?
Yes, our durable liquidity is still very much in surplus, but because of government cash balances and other factors, there have been temporary episodes, very short episodes when market rates reach above the upper band. But the Reserve Bank has developed a number of other tools to manage short-term liquidity, the VRR, etc., and they do those sort of auctions. So they have a lot of space to intervene. Much of the very large durable liquidity created has gone out because of foreign outflows. So now they have the space to adjust both durable liquidity and they have developed tools to adjust short-term liquidity. And I'm sure they will manage it so as to counter. This is not the MPC's domain. This is what they do. But as an academic who has studied this issue, I think they have the tools now and they have the awareness that they need to counter because our economy really suffered in 2019 when there was a huge liquidity squeeze. So I think they realize, they've learned from that also, that they need to make sure that liquidity is in surplus. And that's very important for financial stability. Too much surplus is bad for financial stability, but too little liquidity is also bad.
So you also mentioned the fact that the high repo rates in 2011 and 2014 and 2018 led to a credit and an investment slowdown. So given the fact that inflation still remains well out of target, how would the MPC achieve its target with a minimal growth sacrifice?
Well, as I said, I think Indian monetary policy was too much in stimulus just after the global financial crisis, and then there were double deficits and various fragility. So it became too tight. There was overreaction. And this is what we are seeing the Fed do now. There was too much stimulus after COVID-19 and overreaction now. And we are seeing a lot of problems in financial markets abroad. Yeah. So I think moderation is a lesson that perhaps Indian policy, monetary and other policies have learned to be counter-cyclical, not to let the real rates become too negative or too positive. And as long as we have the policy space to do these kind of adjustments, and as long as we do that, I think we will be able to bring down inflation. Also with monetary fiscal coordination, because there is a lot of fiscal action possible on the supply side. For example, the government targeted free food provision is one reason why wages have not risen. And in the 2010s, we had second round inflation because the rural real wages were rising in double digits almost. Today they are flat, right? So we don't have those kind of pressures today. And we have the policy space to both moderate inflation without hurting growth too much.
All right. That's it from our side. Thank you so much for your time, ma'am. It's always a pleasure speaking to you.
Okay, thank you.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.